Welcome back to the Stock Estate, everyone, where we learn how to swing trade and invest with risk management. And in today's course of Stocks 101, right, okay, we're going to talk about, the psychology of investing as well as trading. So you see, right, 50% of our entire investing journey or our swing trading journey, right, is made out of two components. One, our analysis, how good we are at analyzing companies, analyzing a trade, analyzing our risk to reward ratio. But the other 50%, right, that is actually determined by our psychology and how we think. Okay, we can have the best, the analysis in the world, but when it comes to the buying and selling button, that simple tap of the button, right, requires a lot of psychology and a lot of logical thinking that comes behind it. And if we hesitate, we have the perfect plan, but if we hesitate to execute the plan, right, then it's all for nothing. Okay, you can be a great analyst, right, but if you don't have the fortitude to execute a trade or to get out of a trade and to cut your losses, then you won't be very successful for investing as well as trading as well. But I believe every single one of us have the potential to be a great investor and a swing trader. But we first need to acknowledge that there's biases between us, okay? And this biases comes in every single one of us. And the first step to solving the problem is to acknowledge it. So in today's video, right, I'm just going to give you, the top 4, right, psychological biasness that we all have innately as humans, right? And this always leads us to, have massive losses, right? Because we do the wrong things at the wrong time. Okay, because we although we have the right mindset, we have the right strategy, right plan, but we fail to execute it because our emotions get in the way. So I hope this video, right, will help you to be important to you because you are able to identify what are the pitfalls, and you will serve to be better informed and avoid this kind of psychological traps, and will again help you to save money in the future. So without further ado, let's jump straight into the first one itself. So as you can see from my own infographics, right, I have this ARKG acronym, which is actually something that I just randomly created. Okay, you can use it because it sounds weird, nice. Okay, ARKG, right, ARKG. These are the 4 main biases that we all have as innately as humans when it comes to the stock market. So the first one, right, let's take a look. The first one is actually overconfidence. Okay, overconfidence, right, is in every single one of us because overconfidence has 2 components, right? The first component is we have overconfidence in many times, right? When we have when we read something or we get some sort of information from somewhere, right? And we are very confident, that the quality of the information is very good. And our ability to act on that information, right, is also top notch. Okay, and we are able to execute at the right time, right, for the maximum amount of gain. Okay, we are able to, like example, we are able to get deepest dip, get the execute and get out at the exact timing, right? We have too much confidence in our ability, right, to time the market well. And that leads us to overholding or overholding a certain company, right, or stock, right? In the trading aspect, right, maybe overholding past the resistance level, okay, then watching our open profits turn into a loss. And that is what we do not wish to happen. Because if we do that and that happens, right, that's actually a worst case scenario because is your emotions getting in the way? You had the perfect plan, but we have too much confidence in our ability, right, to time it well. So and not take profits in time or cut losses in time. So overconfidence, right, have a lot of is quite present in many especially the newer traders or the newer investors because they think we read something, then we are very certain about something, and hence this leads us to have a lot of problems in the actual execution of the trade itself. And one study actually analyzed trades from 10,000 clients, right, from a certain discount brokerage firm, right, and they want to ascertain whether the frequent trading can lead to higher returns. And they actually found out that, as you can tell, right, probably they did not. Okay, they found out that the purchased stocks, right, underperformed the stocks sold by 5% over year and 8.6% over 2 years. In other words, right, the more active the retail investor is, right, the more they kind of lose, so the less money they make. Because what they do is they actually, are paying fees, right, to lose money. Because by trading in and out, right, they're wasting, a lot of the potential opportunity cost when the money is being held and not doing anything. So again, right, if you are not able to control your own biasness, right, this overconfidence, right, then maybe it is better to stick to the lower risk and play those longer time frame swing trades, or if you're an investor, right, do dollar cost averaging regularly at a supposed time every single month to reduce the emotions getting in the way. And once you get a little bit more comfortable with it, then you can start moving on to a more active role in your investing journey. And when your account scales to a bigger size, maybe $100,000, $200,000, $1 million, then maybe an active approach would be a little bit better. So how to avoid this bias, right? Okay, is again, this is a very cliche thing. Although this is a swing trade channel, right? I would say trade a little bit lesser. Don't trade too much. Don't trade a lot. As you can see, for my own portfolio, I'm only holding my swing trading is only around 15 to 20% of my entire portfolio. Okay, the rest of the 80% is either in cash or in long-term investments. Okay, so do not misunderstand that I'm trading 100% of my portfolio at any given point in time. No, that's not the way. Because honestly, trading itself, right? It is once it reaches a certain size, right? It gets too much. Example, if my account is $200,000, right, or more, right? So if I'm swing trading $200,000, right, it can get a little bit scary because a little bit of small mistake, right, will lead you to overhold a stock because emotion gets in the way. So again, it's always good to keep it to a small amount. Okay, trade a bit lesser, but I know that a lot of people right now, right, the new traders, investors, they are actually coming to the market. They're actually finding a lot of joy or fun, right? Trading as in the casino, right? It's like everybody's just playing options, right? Playing margin, right? Playing a lot of these high growth companies, right? Speculative companies, right? And they are putting 100% of their money in this kind of speculative place, right? And in trading itself. So that's way too much, okay? So the advice here, right, is trade less, invest more. Okay, but understanding that trading activities, you're trading against a lot of the algorithms, right? The institutional investors, the big funds, right? And they have more data, they have more experience, they have a lot of things. The odds are stacked against you. So for you, right, again, gain experience. It doesn't mean that you can't win against them, but when you're trading with a big amount, right, then you tend to get more emotional and tend to make more mistakes. Okay, so that is the first bias. Okay, second bias is R, right? Okay, so the second one is actually asking you to regret. Okay, regret. I'll ask you to reduce your regret. Okay, oftentimes, right, I'm pretty sure you definitely have experienced it once, right? I definitely have experienced it many times in my trading career per se, right? So you're confident, that a certain stock is like value price, right? Then you have very little downside potential. Okay, then you put a trade on it. Then, but however, right, maybe the last week, right? Then everything turned against you. Everything you got stopped out, everything. But you're still feeling you're right. Like, oh my god, but I didn't sell because the loss was still small, right? You're like, okay, never mind, it's okay. I'll hold diamond hands, right? Okay, so you hold, and you didn't let it go because no loss is a loss, right? Until you sell the position, right? That's what everybody say, right? So it's not a loss until you sell the position, which is true for investing. Okay, investing in a sense, high conviction companies. But however, for trading itself, right? If it continues to go against you, right, but you didn't sell, right, your stop loss, you didn't set any stop loss, then you just keep holding, right? You're just locking up your capital in that instead of moving it to another better opportunity. Okay, and this is regret. Okay, you try to avoid the feeling of regret as much as possible as humans, right? And we often go to great lengths, right, to avoid this feeling of regret. And by not selling a position and locking the loss, right, a trader does not have to deal with regret, right? Because it's okay, well, I didn't do anything wrong, right? Just hold forever, right? Okay, but the research shows that that the traders are 2 times more likely to sell a winning position early than to sell a losing position too late. And all because they want to avoid this regret, right, and losing the pain of losing like money per se, okay, losing the original cost basis. Okay, but however, this is not the way. Okay, and how to avoid this? You want to set a set of trading rules, right, which I always say, the LATE format, right, the LATE format, which I always say in my top 3 swing trade stock videos, right. Have a trading plan, okay, that if it dips below a certain amount, right, set a stop loss, get stopped out. It's okay. If a stock rises a certain amount, right, set a trailing stop loss to let the algorithm, the machine, right, do its thing, right. When it gets stopped out, it stops you out. Okay, don't do your manual trading. Okay, especially for swing traders. Okay, let the machine do its work. Okay, use the stop losses to your advantages. Okay, incorporate a little bit of machine inside within you, right, somehow cyborg, right, to help you with your exit strategy. Okay, so this is very important as well. Third, okay, limited attention span. Okay, this attention span thing, right, is basically, okay, we are exposed to many different outlets of news per se. Okay, so you may follow certain YouTubers, you may follow certain financial articles, you may follow certain Wall Street journals, okay, you may follow CNBC, okay, whatever you get your information from, right, or you may do your own research. But however, right, there's thousands of stocks to choose from, right? But the individual investor, right, sometimes doesn't have the time, especially when we have a second job, right? And we don't have the desire, to research more. Just want to, get someone else's research, okay? Just buy, okay? And humans are constrained by what this economics and psychologists, right, called Herman Simon, right? He called bounded rationality, where this theory states that a human will make decisions, right, based on limited knowledge that they have and the limited knowledge that they can accumulate. And instead of making the most efficient decision, right, they will make the most satisfactory decision at a point of time. So, example, I only look at a few stocks, right? I'm like, okay, these are the 3 stocks I'm going to choose from. When there's actually so much of a bigger pool out there, right, better stocks to choose from, but you didn't go do the research and you just pick out of 3. And that's about it. Okay, so again, this is a little bit relating to the first one, overconfidence, okay, in what you think is good, okay, and as well as they consider that you only consider stocks that you come to attention through websites, financial media, friends or family, but you didn't really do your own research, okay, on the stock itself and expose yourself to a wider range of stocks itself. And how to avoid this bias, right? Okay, recognize that the media has really an effect on your trading activities, okay, and you must learn to research, right, and find companies, right, that are not on the everyone's attention. The beaten down companies, okay, the one that everyone's not talking about, and those stocks are the one that's actually more better for risk to reward ratio. And that's why I always preach here, okay, I want you to learn and do your own due diligence, right, study your own, right, giving you all the skills, all the fishing tools, right, for you to fish and get the best knowledge out of everything. And that's my goal over here, okay. I really hope you guys will do that. Smash the thumbs up button, subscribe to my channel, okay, if you really like this kind of educational content that I'm putting out here for free for you guys. Okay, I really appreciate it. Okay, so last one, right? Okay, last one I'm going to talk about is trends, okay, chasing those trends, okay. This is arguably, the one of the very strongest, biases out there because, behavioral finance, right, researchers found that 39% of all new money, right, committed to mutual funds, right, went into the 10% of funds where, there's the best performing performance in the prior year. Okay, although they always say, the past doesn't predict the future, our past record doesn't, predict the future, right, but investors keep thinking that, it will happen again and again. Okay, so they tend to chase the hottest stocks, chase the the hottest sector like cannabis, whatever for things. But most of the time you are late to the party. Okay, most of the time, right, they act upon it, right, but that sort of information is already priced into the stock already. So you are often buying at the tip and getting dumped. Bam, die. And that's why I say sometimes, right, you have to do your own research, right, and don't just blindly follow someone what they say. Okay, fact check them. Okay, fact check them. Find whether they're credible or not. Okay, then you have to think about whether this information makes sense or not. Okay, you have to think about things. Okay, compare with many different data sources. Okay, and draw your own conclusions. And how to avoid this bias. Okay, first, if you find a trend, right, it's likely that the market has identified and exploited it long before you. Okay, and you really run the risk of buying at the highs, right, and die. Okay, so again, quote this Warren Buffett, right. Okay. Buy when others are fearful and sell when they are confident. Okay, so again, following the herd, right, rarely, produces very good results. Okay, take Cathy Woods and ARK Invest for example. Okay, they're always going against the trends, right? But it's more of like a high risk, high reward kind of approach. Okay, if you really want massive gains, right, you really have to take the extra risk, right, of not following others. Okay, doing your own research. Okay, and sometimes that's actually a lesser riskier option than following the trends. And that's it for today's video. Okay, I hope that you guys enjoy today's video, right? You can screenshot this infographic if you wish to. Okay, you can give me credit, it's fine. But again, right, it is about identifying and knowing that you have all these biases in you. Okay, the ORAT format. Okay, whenever you do a trading or investing, right? Okay, maybe you want to go a refresher from time to time again. Print this out. Okay, paste it on somewhere behind you. Okay, so that you can remind yourself that this kind of traps that your mind always falls into, right? And train yourself, train your mind. It's like a muscle. Your mind is a muscle, right? Like just like you work out in the gym, right? It's a muscle that you have to keep training, right? And once you are very good at training that muscle and it's very well trained, right, it comes naturally to you to not be too overconfident, okay? To not chase trends, to not chase trends as well as to not do all these kind of things, right? That will actually sabotage your investment and trading career. Okay, I wish everyone good trading and good luck, and I hope to see you guys in the next video, okay? If you wish to watch more tutorials, okay, go click on my playlist of tutorials, okay, and you can know whenever you have time, you are eating or something, okay, go watch some of the tutorials, and I hope you guys get a lot of value out of this, alright? Subscribe to my channel, like the video, stock is still out.